I'll try to stay close to the podium because I know it's hard to hear in the back. If you can't hear me, let me know. So I'm David Marra, and I'm the last presenter before your afternoon break. So I'll try to keep it interesting. If somebody could just tell me, how do I move things forward?
There's a clicker, and you just press this button.
Push that button, okay. So we're going to talk about how to do equity allocations using RavenPack data. Let me just get right into it. What we do is we're based in Rye, New York, up in Westchester. And we turn all kinds of data into higher value-added signals like expected returns and dynamic portfolio allocations. These are two big things that we focus on all the time. Our expertise is in predictive analytics, just for finance. That's all we do is finance, and usually involving very large amounts of data. And I'm going to show you today how much data we got involved with when we were using RavenPack data. So what we're doing is we're working with RavenPack to make their analytics more powerful and more useful to investors like yourselves, usually by taking disparate amounts of prediction that are dispersed across 8,000 variables or 12,000 variables or whatever, and trying to compact it down into something like portfolio weights or expected returns. I wanted to step back and just talk about what the motivation for this project was for us. We're going to construct these timing portfolios. They're like ETF, it's related to the ETF replication, index tracking, but doing a little better than the indexes, that kind of thing. And I quoted Cochrane here in the first paragraph, John Cochrane of the University of Chicago, in his latest article in the Journal of Finance this month. And he relevantly points out that we typically are going to model a set of opportunities in the data that are spanned by, say the S&P 500, spanned by 500 securities. But we're going to model that not using 500 securities because we can't really, robustly estimate the covariance matrix, using 500 securities, or if it's the Russell 3000 with 3,000 securities or that kind of thing. So what we're going to do is we're going to assume that these interesting opportunities in the S&P 500, for example, are in a smaller set of securities. And so then rather than trying to find these exact optimums in high dimensional space, we try to find proxies in lower dimensional space. And this is commonly used by practitioners, right? And so what we're going to do is we're going to choose a finite number of well-chosen securities, and we're going to create dynamic strategies for those securities. So what we did was we said, okay, let's take that intuition and apply it to the S&P 500. The logical thing with the S&P 500 is let's just take the 10 industries that compose the S&P 500 the index people sort of do. So we've got 10 industry sectors that span the opportunity set of the S&P 500, and they're the industries that you're familiar with: oil and gas, basic materials, consumer goods, so on. So that was our starting point and our motivation. Just a little bit of notation. We're going to model portfolio weights as a function of state variables. And the first formula just says that X is your vector of portfolio weights and Z is your vector of state variables. And it's saying that your portfolio weights vary over time as a function of state variables. That's basically what we're modeling. And this basically works because the conditional expected returns are also a function of state variables, right? And it may not be a linear function. We had a discussion earlier about whether these things are linear or nonlinear. We make no judgment about whether they're linear or nonlinear. We have the flexibility to model it as it should be, as the data tells us it should be. So our objective is to form a portfolio that spans the opportunity set composed by the S&P 500 using 10 industry sectors. We're going to model portfolio weights as a function of state variables. Now the question becomes is, what are state variables, right? In the literature, they're always called state variables. What are state variables? Well, the literature really defines a state variable, as we all know, as any lagged predictor. It's anything that predicts the first and second moments of returns. and changes in the opportunity set, which more fancier way to say that is changes in the stochastic discount factor. So we're going to consider in this research really two classes of state variables, which are very relevant to why we're here today. The first set of state variables we're all very familiar with. They are the common variables, common across asset classes, and the sector-specific or non-common variables, if you want, that come from the asset pricing literature and we use as practitioners as well. So we have things like macroeconomic factors, the CAPM, the intertemporal CAPM factors, measures of liquidity, measures of uncertainty, the price risk factors from the 4-factor model, or if you're into the extensions, the 6-factor and the 9-factor model, like momentum, small minus big, large minus small, that kind of stuff. So the price risk factors, and then technical factors. And there are lots of these factors that have been developed in the literature over the last 30 years. Particularly when you include the various parameterizations of these factors that have appeared in the literature that you can kind of fool around with. So that's the first class of state variables we're gonna put into this. The second class of state variables is, of course, financial news data, which represents information that's impounded by markets into prices or that reveals prices, reveals future prices. And I think you're all probably very familiar with the RavenPack data. RavenPack was kind enough, Peter Hafez, head of research at RavenPack, was kind enough to provide us with a large data set of things that they felt were very relevant to this research. It's news volume and sentiment indicators. There's two basic groups. And then within those two basic groups, it's filtered by event group. So event could be like, is it an M&A type of issue? Is it a credit type of issue? RavenPack has lots of filters to filter them into these different groups. Filtered by relevancy, novelty, and sentiment direction. And RavenPack did all that work. It's aggregated then hourly, daily, weekly, monthly, and quarterly. Those are the basic aggregations of it. Those are really aggregations. And there are some smooth moving average windows there as well. And then they're aggregated by company up into sector and market data, which is what we were primarily using. So in terms of data size, this is what we're dealing with for this work. For the RavenPack news files, we had a US market file, which had about 3,500 fields, 3,500 variables. Then we had each of the 10 industry files, each of which also had about 3,500 variables. And then Arialytics produced a sort of corresponding market file with about 4,000 variables in it, and then an industry file for each of the 10 industries with about 4,000 variables in it. There's our two classes of state variables that we're using. So we've got about 15,000 variables per industry. It's daily from 2001, and it's timed to just about 90 minutes, I think, prior to market open. So that an investor could use the output of this data, of this process data that we're going to get into, to make a decision daily. So, it's obvious that, ordinary least squares regression is not really a good tool when you have 15,000 variables, right? So we got to do something else. And I just want to keep in mind that what we're using here is we're using portfolio weights, which are estimated from these expected returns estimates. That's what we're creating, expected returns estimates from which we're going to estimate portfolio weights. We're using our predictive modeling platform, this is what we're all about. It extracts statistically significant relationships in large amounts of data. It's powered by, it does it using very strict procedures. So it's all using just information. If you're standing at any point in time, at point t, it's only using information up to t-1, so that there's no bias in it. So it's a sort of strict walk forward type procedure. Uses structured and unstructured news, so financial and financial data and news data. And it sits atop this sort of high performance parallel compute platform. Now here's how we constructed the portfolios. I felt it was really important, when you're coming to present to an audience like this, that the portfolios that we construct be very understandable in the room today, right? That means they're not highly parameterized, they're not optimized. The data is what it is. And so working along with my colleague, Elliot Taniguchi, we created what we think is this very, they're suboptimal in some sense, but they're not parameterized, so they're intuitive. And that was our approach in this research project, knowing that we were going to be coming here today talking about this. There's different ways we could have constructed these portfolios, but we wanted to keep it simple. So the long-only construction is just like this. We've got these 10 expected returns estimates. And we're going to allocate equal weight every day to the securities that had positive expected returns. We're going to allocate 0 weight to anything that had negative expected returns. And we're going to allocate whatever 0 to cash. Typically, it's not very much. And we're never going to rebalance more than 5% on a typical day, on a particular day, although the rebalancing is typically much lower than that. That's it. There's no other parameters to it at all. So here are the results we got. So this is long only, 10 basis points round trip expenses. The highlighted column, the first column, is what we call the RavenPack long only portfolio using the weights that we calculated. We have the equal weight portfolio, which just takes the 10 sectors and equal weights them. And then we have the S&P 500 returns on the right-hand side. And what you can see is, we have average excess returns, the Sharpe ratio, average excess returns x the S&P 500. The first one was x the risk-free rate, the turnover, the maximum drawdown, and then the number of drawdown days. And we can see across all of the performance measures that we looked at, this portfolio does better. It lowers risk and delivers a bit more return. And for people for some people, 350% annual turnover is, for some strategies that's fine. For other people, that's a little high. Different investors have different needs. We're gonna control for turnover later, but this is a completely unconstrained, non-controlled results. Then we also wanted to construct long-short portfolios, and we did these 1-30-30 long-short portfolios. So the portfolio is always 100% long, and it goes net 100% long. But it goes 130%. It's weighted. It's equal weighted for the expected returns. It's equal weighted for expected returns which are positive, and we put 130% weight on that. And then it's equal weighted among the expected returns which were negative, and we go 30% short that. That's how we did it. It's pretty standard. And the same thing, we rebalanced no more than 5% per day. And here are the results. So same, X transaction costs. We improved upon the results, right? So the results got better with the long and short. The first column is the long and short. The second column was our previous results from the long only. And we improved upon the results. And this is only about 4 years of data. But what I think it shows, the time horizon is a little bit short. It's 44 months of data, I think. It shows that we're able to extract the full amount of information in these analytics. We're able to improve the performance by recognizing when there are going to be downturns and adjusting the portfolio weights for that. I think that's a very significant result. You can see there's less drawdown and quicker recovery too, slightly quicker recovery with this, but less drawdown, and of course higher Sharpe ratio. And this is what the results look like, in a time series. The darkest line is at the top is the long-short portfolio. The next darkest line, or the next lightest line, is the RavenPack long portfolio. And then we have the equal weighted portfolio. and the S&P 500. And though the equal weight portfolio and the S&P 500 sort of converge there at the end. And this is just indexed to 1, what the total return to what a $1 investment would be over the horizon. And I wanted to point out two or three drawdown points. The first one here, the second one here, and the third one there. We can see where the RavenPack portfolios perform particularly well in terms of minimizing drawdown during the deepest drawdown periods. We thought that was interesting and obviously was also a good result. But it shows the predictive information locked in this data, we felt. Then, as I mentioned, the turnover comparison. Here we just controlled for turnover, and we basically wanted to get it half of what it was in the unconstrained case. As you can see, we lose a bit of performance, but we're still above the benchmarks by quite a bit. So I think our takeaway from this was it showed that we could meet different investors' needs with approaches like this. The second thing we wanted to do then was we just went through what we could call like a top-down analysis, right? We've got the S&P 500. We want to proxy the opportunities in the S&P 500 by 10 industries. It's like this big top-down approach. That's a great approach if you're building an active ETF or doing ETF replication, things of that nature, building a mutual, things of that nature. What we wanted to do here was we wanted to take an investor who's an asset manager that already has a portfolio and see if we couldn't help that investor through daily rebalancing to either take out some risk or get a little bit better return. So what we did is we just did a pseudo-random sample of large cap equities, and RavenPack kindly provided us with I think a top 100 largest equities, and we just sampled 9 of them out of it that would kind of represent different sectors and not be overlapping. That was the idea. And then we did the same portfolio construction, the long only and the long short portfolio construction. We had a little bit less data here, just ran out of time. We got 33 months of data. And here are the results. The benchmark is the same benchmark. It's the equal weight of these 9 individual equities. And the lowest line is the S&P 500. And then the 2 top lines are the long short at the top, and then the long only as the next line. And we get even better performance than before. And we felt that this illustrates how we often spend a lot of time selecting the equities that are going to go into our portfolios, right? We're selecting these equities, we're going to hold on to them for a while, we're placing our bets. And I think this shows that if you can take a more active approach using this type of data to daily rebalance and take out some of that risk or maybe chase a little bit of alpha. But that's what, using a bottom-up approach, using what you have to do a little better. Here are the results, using the metrics we had, sharply higher Sharpe ratios, and sharply lower maximum drawdown recovery days. And then here are the results where we controlled for turnover. Again, we were targeting roughly half the level of turnover. And we can see, still pretty good results. And showing that we can control for turnover, we can meet different investors' needs, and still get an improvement. So in summary, it's a limited amount of data. But we thought it was very promising results. We found that from the top-down approach, it seemed like a very good opportunity to build ETFs with value-added performance characteristics, maybe some higher alpha or reduced risk. And then the bottom-up approach to build very unique equity portfolios, either from scratch or to derive better performance from what you already have. You've placed your bets, but you want to rebalance a little bit daily and do a little better as a result of that. And this information could help you do that. I think the S on context was supposed to be up there on the left. I like to talk to investors, so feel free to reach out to me. You can, of course, reach out through our website. Feel free to reach out to me anytime. Or for more information on the indicators that we're creating for RavenPack, you know who to reach out to for that. With that, I'm happy to take any questions.
Very interesting presentation.
Thank you.
You mentioned you were handling about 50,000 variables for a long time period, and I was wondering if you could share any infrastructure technology that was involved. You had structured data, unstructured, RavenPack, using grid computing. Did you have an unstructured database, HDFS, Hadoop, Couchbase?
Right.
Using MapReduce.
Sure.
Just wondering, I'm interested in the field of big data and where it's going in space.
Yeah, sure. That's a great question. This is for those of you who are not familiar with this is an ever-changing space. It's a really hot area in terms of software development and really hardware development as well. The cross-section of what we're doing, as the person who asked the question alluded to, is at the cross-section really of where statistics, asset pricing, and database, this kind of really fast database management stuff, all kind of converge. In terms of and there's a lot of innovation going on. Oracle and all those related parties, IBM and all those big parties are working on all these related technologies. We're primarily work on the software side, right? But in terms of hardware, what we have is basically have what I call a common supercomputer setup, if a supercomputer is common. But we used the latest generation of Intel's chips, the fastest things we can use that won't overheat. And we pack as many into these very, very dense spaces into cabinets. We have a supercomputer vendor for that, our vendor supplies a lot of DoD and NSA and all those people with computers. So they are very capable of building this stuff for our specifications. In terms of software, you mentioned Hadoop. And a lot of people, more and more finance companies are embracing Hadoop. It basically manages lots of amounts. It's called a distributed database. It's just a fast way to access lots of data that's stored because we're storing more and more data, right? The whole reason why big data has come about is because the world is producing more data. It's growing about 50% a year. So we've got to store more of it. We've got to search it faster. We need tools like ours to traverse larger parameter spaces, all this stuff. We did not go down the Hadoop route. We ended up writing our own version of Hadoop over the last 4 years just because it was easier for us to program exactly what we needed rather than to reprogram Hadoop to do what we wanted it to do. But Hadoop is also a very good tool for this kind of thing, and many people are using that as well as other people have gone down the route we have, which is to kind of write our own custom stuff. I think those are the two big pieces.
Hi. Yeah, those are very interesting results, very good results. I was just wondering what plans you have to go further back. I mean, obviously 2010 till now aren't quite that representative in terms of some of the bear markets we've had, so I'm wondering what you're planning to do as far as going further back in testing.
Right. Yeah, that was why you're absolutely right. And that's I was pointing out, where the downturns were and we performed well. So I was hoping that was proof to us that it kind of works during downturns. But you're absolutely right. More data is better and gives us more confidence in the kind of results we could expect. So we're addressing that currently, along with RavenPack. RavenPack data goes back to 2000 or 2001, at least what we received. And we're just going to put some more compute power behind it and generate these longer histories over the coming weeks. As well as address, frankly, not only just address the equity space, but as well as address the non-equity space. We've been doing a lot of work in currencies and commodities, in particular commodity futures. So there's those other exciting things as well that we want to look at.
David, I have a question. So you talked about the need for some pretty serious computing power to produce these results. Now, how scalable is it to manage larger portfolios?
We've had clients come to us. One of the biggest clients that came to us, I'm going to illustrate through a client example. They came to us with they already had a strategy and they needed analytics behind it. And they had 40,000 predictors per security, and they had 2,000 securities. That's a big problem. It's a multi-tera. It's not a petabyte problem, but it's a multi-terabyte problem. And the answer is, even when you scale up to something that large, it's doable. Now you got to throw a lot of horsepower. We've tested our system up to 1,000 cores. It fully scales. It's just how much hardware are you willing to throw at the problem. Our software is completely scalable, but the bigger the problem, the longer the time series, the more assets in there, the more horsepower you've got to throw behind it. Now, but to John Cochran's point, which I mentioned earlier, you don't really have to do that, right? If you want to replicate the Russell 3000, you don't have to run this for 3,000 assets. We can very smartly choose 10 or 20 or 40 or 50 assets, as we did with the S&P 500. We chose 10, and we may be able to replicate that just fine. So there are smart ways to do this stuff where we don't have to get into the 10,000 core solution or the 3,000 asset solution to get what we want.
I have a question as well. You showed using 10 industries predicting or coming up with a portfolio outperforming the S&P. Did you try to go directly after the market portfolio, so aggregating it up to market level instead of using the industries? You mean
do an expected return on the market itself?
Exactly.
We didn't do that yet. I suspect you're going to lose something though, just logically. I think that's an interesting area for future research. You may, however, lose a bit, because the reason why this kind of works is because the 10 different assets you have aren't fully correlated with each other, right? So they're highly correlated with each other, but they're not fully correlated with each other. And if we can get a good expected return, we can exploit that time variation, right, in those. And that's really where the returns come out of. So I think it's really interesting, and we should address it, but we probably wouldn't get quite as good a result.
Sector level instead.
Yeah. Or what we could do is we could do U.S. market, European market, Japanese market. Now we're talking kind of thing, right? Yeah.
Any more questions?
Thank you.
Great. Thank you.
Thank you.